What are we going to do today? We're going to do a few different things. We're going to look at substantive audit procedures. We're going to look at designing some substantive audit procedures. And then, more importantly, what do we do conclusion-wise? But the key today, out of all of the things that I suppose I want you to take away, is the stuff that we're going to do on design. All right. It's a really important part of passing the subject is being able to show that higher order skill of being able to create audit procedures to fit a particular situation. And I'm going to go through some basic steps. I've got a 4-step foolproof method for doing it and some guidelines for you. All right, so we know that ASA 500 says that I have to do a couple of different things in regards to my audit evidence. It says that my audit evidence must be sufficient. And it also says my evidence needs to be appropriate. All right, so what exactly does that mean? The appropriate part really refers to making sure we are doing the right sorts of procedures. So when you go a bit further into ASA 500 and the other ASAs, they talk about the nature, timing, and extent of executing audit procedures. And so for us, appropriate means nature and timing, all right? Picking the right sorts of tests. So if I want to test occurrence of sales, I need to do some form of vouching because that's the best test related to that particular assertion. So I have to pick the nature of what I'm going to test, what procedure out of the 9, and when I'm going to test it. And then I also need to think about the extent, and the extent is how much, which is this question of sufficiency. Right? How much evidence do I need to collect to be able to give a conclusion or an opinion with reasonable assurance that I am telling them the correct thing? Now we know we do have our audit risk model. We've looked at our audit risk model a few times. It's a function there of inherent risk, control risk, and detection risk. And we also use it in this sort of format. Detection risk, audit risk over inherent and control risk. We also know that there are certain relationships that are predictable. So inherent and control risk move in an inverse direction to detection risk. So they move in opposite directions. And when I execute substantive procedures, they reduce my detection risk. And remember, my detection risk is the risk of not detecting a material misstatement. All right, so it's really key that you remember that bit about it's the risk of not detecting a material misstatement. All right, so the risk here, because of the risk of not detecting material misstatement, the more substantive testing we do, the lower the detection risk is going to be. All right, so that sort of makes logical sense. The more evidence I collect, the more detailed checking, the less chance there is I'm going to miss something within my audit. Now, if inherent and control risk are low, then because it's an inverse relationship, we have high detection risk, and we're going to do a smaller number of audit procedures substantively, but we are going to do an increased amount of controls testing. All right, and that's what we'd be doing under the lower of assessed level of control risk approach. All right, so our detection risk is higher because we expect there to be very few misstatements because of the low inherent risk and really good internal controls to try and prevent and detect material misstatements. So just an overview of the table we already know. Our control risk assessment, we know that we make 2 assessments. We make a preliminary assessment, and then if control risk is low or medium, then we do some testing and make a final conclusion. All right, and that's what we looked at a little bit this week in our homework and in our Cloud 9 stuff. All right, so we make a preliminary assessment, low control risk, and then here you can see controls tested extensively and able to be relied upon. So that means there we don't have any deviations that exceed what's tolerable. Medium, some controls, and they are reliable, or high, no controls. And the key part there, no assurance from those controls. All right, so we're not doing any controls testing, and as a result, we would generally do lots of substantive procedures. Okay, so what we're going to focus on today is actually one particular part of this table, which would really be this bit here. Right? How would we do some substantive procedures over a large portion of accounts? And I'm going to do some walkthroughs and some demonstrations of that. Okay, so what about risk assessment? Risk assessment is something, risk assessment is something that we all have to do on the audit, and it is required under ASA 315 because we take a risk-based approach to the audit. Areas where there are higher risk of material misstatement are the areas I'm going to spend more time on and more effort on in the audit. So I need to start by identifying those areas of high risk. I also need to identify that risk at the assertion level. So that means I need to, for any particular account, identify which assertion is at greater risk of material misstatement. Now at Cloud 9 we know that there are higher revenue targets for managers, and when they reach those revenue targets then they receive bonuses. So certainly if I was thinking about Cloud 9, at the assertion level there's a high risk over the occurrence assertion. Now that doesn't mean that I forget about classification or cutoff or completeness or accuracy. I still test all of the relevant assertions, I just don't test them all to the same extent. All right? So I'm going to spend more time testing the assertions that are at greatest risk. Let me write that down. Spend more time testing the assertions that are at greatest risk of statement. All right, let me watch that. There. Okay, now we can put our assertions as audit objectives, and that's really simply taking an assertion and putting it into everyday language. So if I was looking at the occurrence assertion for sales at Cloud 9, my audit objective would be to conduct audit testing to determine whether all sales really did happen or occur. Right? That's my objective for the audit, using the assertion as the framework. And that's what our goal is. We want to make sure that every transaction really did happen, is correctly recorded at the right amount, in the correct period, using the right journal entries, and all of those transactions are recorded. So assertions stated as audit objectives is nothing new. So let's move on to, I think this next one is a table. Yes, okay, I'm going to just move this table a bit this way so it's a bit easier to see. Okay, so here we see different types of assertions. That one. So we've got our transactions, we've got our balances, we've got our presentations and disclosures, which is about our note disclosures and presentations into the accounts. Now what we are going to focus on for the remainder of our term is these ones. And you might ask, why am I focusing on these and I'm not really thinking about the presentation and disclosure assertions? It is important to understand that they exist. You know, for everything that appears in the financial statements, I want to make sure it really happened. I am allowed to report it. It's all reported, correctly recorded, and more importantly is understandable by those reading the accounts. But this is normally performed by staff at a much senior level. All right, so performed by senior staff on the audit. So for the purposes of having you guys work ready, I suppose, ready to go out there to a vacation job or a graduate job in auditing, you guys are going to spend more of your time auditing these. All right, so that's where I'm going to put my focus on for the course to make sure that if you are going to an audit, you are able to test the occurrence of sales adequately the first day running. So that's really the important part. So what are substantive procedures? It's important to note here that substantive procedures are those ones that are designed to detect material misstatements. Okay, so they're looking for dollar value errors. Our controls are checking whether the controls are operating correctly, but here is where I'm really looking for numbers that are not correct. Okay, and so they provide us with direct evidence about whether each account meets the assertions. The controls provide indirect evidence. If I'm testing the internal controls, the controls act as a protective layer over my accounting data. If I test these, then I have direct evidence that controls are working, but only indirect evidence about the accounting data underneath. Okay? Whereas if the controls are crappy and I delve straight into the accounting data, then I have direct evidence about whether the accounting is correct or not. So when I'm testing controls, the evidence we gather about the correctness of the data is actually just implied. Now we also know about our audit programs. Our audit programs are our recipes for doing the audit. And just like when you go to a restaurant and you go to a degustation, there's 10 or 12 different courses, our audit will have lots and lots of audit programs. Right? Audit programs for every single different component of the accounts. All of those audit programs are going to be different because different assertions are at higher or lower risk in each of those accounts. There might be good or bad controls around each of those accounts and higher or lower inherent risk around each of those accounts. So we use the audit program as our recipe. I think that's probably the easiest way to think about our audit program. So, have I given you guys the fried rice analogy? No? Okay, all right. So let me tell you how audit programs are like fried rice. We all know what I'm talking about when I say fried rice. So, yes? Okay. So, obviously, I'm Chinese. My mum is one of 6 siblings. And being Asian, and I'm sure it's quite like this in a lot of European cultures as well, family events revolve around food. Yeah? And so there's, you go to a lunch and you always end up taking home more food than you actually brought with you because your aunties make so much food that it's absolutely crazy. So my aunties all have disagreeing opinions on what makes good fried rice. All right? One of mine who's really on a real health nut, fried rice can only be made with brown rice because brown rice is better for you because it's lower in GI, it's low GI. Others have different disagreements about whether the rice should be cold or hot when you cook with it, whether you should or should not include onions and peas and corn and carrots, whether you pre-cook the egg and then chop it up and put it into the fried rice, or whether you crack the raw egg onto the fried rice while it's still cooking and stir it around. All right? One of my aunts loves to put pineapple and chicken in fried rice. That just is not my thing. But when we have family dinners or family get-togethers for Father's Day or Mother's Day or Christmas, everybody brings fried rice. Right? They lay them all out there on the table. They try and make similar-sized containers because apparently whoever's fried rice is eaten the most is the best. It's a bit of a weird, unusual family thing, but, every family has their idiosyncrasies. And the reason why I use this analogy is that it's all really tasty, right? All the fried rice is good. It's all edible. It's all relatively healthy for us. And they all achieve the same objective, which is being delicious and filling your tummy. But there are lots of different ways to go about it. And that's exactly the same with our audit programs, all right? Our audit programs for the same account and 2 different people looking at it and designing an audit program can be completely different, but as long as that procedure or the procedures they've listed meets the objectives, then that audit program is valid, all right? Which means when it comes to designing audit procedures and you're doing your homework, don't be freaked out if everyone in your group has different answers, all right? Because they're all likely to be equally as valid, but just different ways of doing things, all right? So I always say recipe, and I always use the analogy that audit programs are like fried rice. You'll never look at fried rice again the same way. Hopefully not. Every time you look at fried rice, hopefully now you'll think auditing. If that works, then my role here is done. Okay, so what do I need to think about when I consider the nature, timing, and extent of my audit procedures? And remember, nature and timing is what 9 procedures am I going to use, and extent is how much am I going to collect, all right? So I've got my substantive procedures. They're influenced by risk. More risk, more testing, or more procedures. I need to think about timing. If I'm really worried about inventory and whether inventory really exists and is being counted correctly, I'm probably going to do a lot of work around being there on the 1st of July to do stock take. If it's really risky, I might even say to the client staff, don't do the stock take. The auditors are going to do it to be absolutely sure of the information that we're collecting and the results that we're getting. I need to think about the level of assurance that's necessary. If I'm going to rely on substantive testing a lot, so in these situations, reasonable is when my DR would be low, or if I've got limited testing when my DR is medium. All right. So remember here, I want to do lots more substantive testing because that's all I've got. All right. No controls, so I'm going to do lots of substantive testing. Or here, I have some internal controls to rely on, but I still need to do some substantive work. I need to think about the type of evidence in terms of how persuasive, how reliable the evidence is. So persuasive, reliable. And also the complexity of the client system. So the more complex, probably the more evidence I'll need to collect to make sure that it's working appropriately. All right, so this is a really important point here where it says that the nature of substantive testing varies from account to account. All right. So and this is quite common. Companies usually have really great, tight controls over paying out money, over buying and accounts payable. But they often have less controls over sales and accounts receivable, money coming in. That means that I might take a controls-based approach with limited testing on accounts payable, but then I might take a very substantive approach over revenues and accounts receivable. So we need to be flexible, all right? And that flexibility is important because if I'm not flexible, then as I discover new things at the client, new risks, new controls, then I can't make my audit as efficient and effective as possible, right? If I can't change my audit strategy, adjust what I'm doing, especially if I'm doing a controls-based approach and I find risk or I find errors, if I don't have that ability to be flexible and shift to more substantive testing, I could be giving the wrong audit opinion. So that's really, really important. Now there's 4 different things I'm going to talk about in terms of how we might gather evidence and the mix of the procedures that we're going to use. Testing key items, representative testing, testing underlying data, and analytical procedures. So let me go through each of those. All right. Timing. The more risk we have, the more closer we're going to do things at the year end. And I'm going to talk about the roll forward procedures because this is something that's a little bit unusual. Okay. The roll forward procedures says that, let me draw a little timeline here. All right. So let's say this is the financial period. All right. And this is 3/4 of the way through the year. So if I test internal controls over this 3/4 of the year and controls are working correctly, control risk is low, when I come back at this period here, if all of the controls that were in place here have not changed at all in this last period, then what I'm going to do is I'm actually going to cheat a little bit and I'm going to roll forward this audit testing. I'm going to say that the testing that applies here would also apply here even though I haven't checked it, because nothing in the internal control system has changed. All right. So the roll forward we see a lot in publicly listed companies, your ASX listed companies, because they try and contain their changes to their systems to one particular period in the year rather than making changes every single week the entire year round. The roll forward process also works between years. So let me just change colours of my pen here. All right. So I'm going to have 3 different years. Year number 1, year number 2, and year number 3. All right. In year 1, I go away and I test internal controls, and I find controls are working really well, and I say, look, controls are really great, control risk is low. Okay. Now, when it comes to year 2, if in year 2 there have been no changes to the internal control system at all, nothing has changed between last year and this year, then this testing can roll forward and we say that the results we have from year 1 would equally apply to year 2. Okay? Now when it comes to year 3, again, if there have been absolutely no changes in internal controls, you can take the results from year 1 and roll them forward into year 3. All right? But once you get past year 3, let's say we get to year 4, at the 4th year you have to test again. Okay, so we need to retest. All right? Now, that's theoretically what is allowed to happen. How many companies do you think go through an entire year with no changes to their internal control system? Not very many. All right. So in the majority of circumstances, we are testing in this year and in this year, but in some circumstances, the roll forward can actually happen. All right. Now, in terms of timing of substantive procedures, everybody has to do a basic minimum level. All right. And that means, and this is the control risk is low section, right? Where control risk is really, really low, controls are great. I'm going to focus mostly on testing controls. I do a tiny, tiny bit of substantive testing. As the risk, the inherent and control risk go up, then the amount of testing goes up, and then the more that we do at year end. All right. Now, that it says the more that you'll do at year end, but in this instance, you'll also audit substantively a lot at the interim period as well. So that's sort of a little bit not quite clear in the diagram. Now, in the textbooks, you will see 3 different types of tests of details. They call them tests of details of transactions, of balances, whoops, I can't spell, and analytical procedures. Okay. Now, when it comes to actually learning about these and designing tests, I am really not so stressed out about having each of these correct. All right, so that is not such a big deal for me. What I want you to focus on is designing a good procedure. That procedure may be a test of transaction, it may be a test of balance, or it may be an analytic. All right, but what I'm interested in is designing the best test possible. And when you go down this route of sort of organizing it like that, yes, that's how tests fall into different sorts of categories, but often it creates more confusion for the student. So I just say focus on tests. They're mostly a couple of different common things that we know a lot about already. Most procedures involve vouching or tracing, starting at one end, moving forward, starting at the end, or moving backwards. And then usually, when you are doing that, when you are vouching or you're tracing, you're also usually inspecting stuff and recalculating stuff, all right, at the same time as when you're doing those items. So don't think, oh, I'm just vouching, so therefore I can't recalculate. It's really mix and match. So if I'm vouching sales journal entries back to shipping documents and orders from customers, I'm inspecting documents. If I'm checking that the amounts on the invoice also match the amounts on the journal entries, I'm going to be doing some recalculating as well. So there's a lot of mix and match in there. So how much to test? All right. The decision on how much to test is impossible to be absolutely certain, especially because we use a lot of non-statistical and haphazard testing. So there's a couple of different key things that you can do. The first one is test key items, and key items are usually the largest transactions within a balance. All right. So I'm going to give you an example here. Imagine this is the value of accounts receivable at Cloud9. Okay? Now, Cloud9 has 4 very large customers, right? 4 major customers: Foot Locker, Rebel Sport, Maya, and David Jones. And those 4 accounts cover a really significant proportion. I can't remember what it is from the text, but let's just make up an estimate here. So let's imagine, make my pen a bit thicker, that much of the accounts receivable is made up by those 4 customers. All right, so let's write that. Whoops. Big 4. Oh, sort of like the Big 4 audit firms. So we've got the Big 4. If I'm doing key item selection, then by confirming the accounts receivable of the 4 biggest customers, I've also gathered assurance over most of the value of the account. Okay, so key item testing means that we can cover a lot by looking at a few transactions, and that's pretty efficient. All right, now this usually works for balances. Doesn't work so well for transactions. With transactions, you need to search and do a bit more what we call representative sampling. All right, so this is accounts receivable. Let's do one for sales. Let's say this is all of sales. All right, and let's say we have small customers, medium customers, very large customers. That means, of course, that when I select my sample, if 1/3 of the customers are large, then 1/3 of my sample customers should be large as well, to make sure that I can make an appropriate conclusion. All right, so that part all comes down to being able to draw my conclusion correctly when I project errors or misstatements. All right. So I talked about key item sampling. I talked about representative sampling. The other thing that we need to think about is look at underlying data. All right, journal entries just don't appear by themselves. Journal entries get generated based on transactions, which are often backed up by other forms of written reports, etc., that might not be within the accounting system. So they could have a schedule or an Excel spreadsheet. And we do a lot of tests of underlying data if I'm going to use analytical procedures. All right, ratio analysis is only as good as the data that comes out of the system, and that's only as good as the internal controls around that system. So looking at the underlying data is important. All right, analytics. Analytics, and it says that analytics can be used as a primary persuasive test of balance. And I'm going to put a caveat on that. For low risk and or small balance accounts. All right. You don't want to test just sale. You don't want to test sales with just analytical procedures. There are different sorts of analytics. There's persuasive, sort of a medium level, and not relevant or not very useful analytical procedures. But the key for an analytic is that the analytic sort of works a little bit like a radar or a sonar on a sub. All right, let me just draw a diagram here. That one. Okay. So, imagine, I'm thinking back to all the movies I've seen about submarines and that sort of thing while I'm drawing this. Okay. So, we know that it usually starts from a center point and then radiating out from there, the sub uses sonar to send pings out, and if it hits something on the system, you get a little dot, right? And the dot says there is something out there. Okay, and we use this to measure distance, all right? Does the little ping tell us exactly what it is? No. And that's the same as the analytical procedure. The analytical procedure says, hey, there's something over here. I can't tell you exactly what it is, but it's worth going out to investigate. All right? So the analytic doesn't allow you to directly identify the error, but it can give you a little reading that says, here, go have a look in that particular spot because we think there could be something there. All right? So they're a really powerful tool because the accounting landscape and the number of transactions, the number of journal entries is huge within any organisation. So if we can narrow down our search, that'll make our search a lot more efficient. So the different types of analytics, the sorts of things that we focused on and that I've got you to talk about a lot are our ratio analysis. Who remembers CMS? Break even? Cost, volume, profit? Some people look less than happy that I've mentioned. We've got our cost, volume, profit analysis. Do you guys remember doing variance analysis with the little tables? I still remember drawing those. So you could use all of that in analytics. Now, so far, we've only looked at analytics for the entire company, inventory turnover for an entire company. But I could do something like inventory turnover by product line to help me find obsolete items. All right? I could use some sort of variance analysis to help me discover what the amount of wastage might be, or the amount of product we could be producing using the information. Now these two, pattern analysis and regression, I don't see so much of. All right, because, and do you guys do business statistics? Yes? Do you remember doing regressions in business statistics? To do a regression well and to get a good fit on a regression and a good R-squared, do you remember R-squareds? You need a lot of data. All right, and on an audit, we just don't get the sort of data that typically we would need to do pattern analysis and regression. Now, that may be changing with a lot of research into data science. And here at UTS, I'm actually about to start talking about a project that'll start officially next year with the UTS data science group about how we can use data collected on student learning to help you become better at what you're doing. So there is lots of stuff out there, and PwC and all the big consulting firms, IBM, etc., are really pinning their money on on data science and data mining and using all the data that companies collect to generate value. Whether we're going to see that in audits, I'm not sure. The jury is out, but I can imagine that McDonald's, Coca-Cola, Woolworths must have huge amounts of data that perhaps if we could use the right sort of system or algorithms or analysis that we could use for audits. But it's a lot. Now, one key thing to remember is that an analytical procedure uses data from the client system. So, reliability of that data is really, really important. So, when I'm testing the internal controls, control risk is low, then I'm probably going to do a lot more analytical procedures because that data is reliable. If control risk is high, I'm probably going to do less analytics using client data because we don't know how much of it is in error or not. Analytical procedures might be less useful when operations are diverse. So if I was going to do analytics on Woolworths, I'd probably want to do it by segment because how Bunnings operates, how Masters operates is very different from the supermarket sector, right? We know Masters has been making a loss. They lost their CEO who resigned over the failure that has currently been Masters. So diverse operations means aggregation of data might not be easy. If we're comparing with industry data, it might not be reliable or it might be the wrong sorts of industries to compare it to. So think about biotech, right? Biotech industry is everything from nanotechnology, which is really new and emerging, to something that's really well established like cochlear technology, which is the hearing implants. So if you're a new startup firm and you're being compared to medical science companies that have been around for a long time, that might not be a great comparison. When there's a lot of inflation, it's not any good. So, you're never going to do analytical procedures on companies in Zimbabwe, where when they run out of money, they just print more. That's always going to be an inflationary issue. And if you're using budgets, comparing actual to budget is no good if the budget isn't well controlled. So how do I do my analytics? In terms of the process, I need to think about what comparison can I make? What could be useful? All right, so I'll draw some little examples here. Let's imagine that we have a company. This is time down here, and let's say this is sales volume. All right, and I know, or let's say I'm worried about managers fudging sales. So I'm going to draw a red line here, and let's say that the red line is sales made by management. Okay? Now, if I'm a little bit worried that sales may not be all that they appear to be, then what I might do is compare sales to something like inventory movements from the warehouse. Okay? And what if I discover that it looks something like this? What we have, if we've got sales line and then we've got our inventory movement over here, then what we have is potentially an issue where management might be fudging sales. Because let's say this is, if this is something seasonal and these are the parts in which we wouldn't buy the product, but they still want to make a bonus, then they might just create some fake sales. The company might not notice because all sales are steady, that's good. But when we look at inventory movements, we might notice that something unusual is going on. All right. So you could overlay anything. If you thought that the manufacturing plant doesn't look like it's making everything that they say, or they're making more than is expected, all right? And this happens, a lot of knockoff clothing that gets made overseas is actually made at genuine Ralph Lauren factories, all right? But the employees work 6 hours a day to manufacture for official Ralph Lauren, and then they might work an extra 3 hours a day using the same materials to manufacture for the knockoff market that they might sell at sort of, your local markets. I know that certainly the rumour is that that's been happening with a lot of big brands. Sometimes you're in Southeast Asia and you see knockoffs at the markets of shirts and things. You think, these look actually really good. And it's often because they come out of the same factory, but manufactured on the side by the employees. So if I noticed that there was 500,000 units of something made, but we've used 800,000 units worth of material, I'd go, where the heck is that going? So we can use lots of different information. We can estimate probable balances or outcomes. It's quite a common thing with depreciation. Right? Gather all the client data, find out how they do depreciation, build your own spreadsheet, and see if you can estimate. Do our calculations, and draw conclusions in terms of where to go next. All right? Is this like the little radar diagram or sonar diagram that I had before? Where does it tell me I could go and investigate for potential errors or misstatements? So what about using computers? When I started audit 1,000 years ago in a galaxy far, 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 far away, imagine the Star Wars music playing there, computers weren't as fantastic as they were today, as they are today. All right. So computers were clunky things. They didn't last very long on battery power. 1 or 2 hours on battery was great. Sometimes not everybody on the team had a laptop. You'd have to share them amongst the team. So everything was done by hand. When I first came into auditing, we still had some audits done by hand, but auditing was moving to the computer age. So spreadsheets, all right? Can you imagine checking depreciation calculations without spreadsheets? Or doing inventory turnover without spreadsheets? That's the reason why the profession overall is probably less people in numbers, because now computers have replaced hundreds of graduates doing manual calculations. But we have more complexity in clients than ever before. So software can be used to interrogate and examine client files. Now, of course, these days, if you ask clients for a dump of all of their journal entries, they're probably just going to give you a hard drive. When I first was auditing at Coopers & Lybrand, which is now PwC, we went to collect the data dump from the client, and it was magnetic tapes. Now, do you guys know what a cassette is? Cassette tape, right? Imagine a cassette tape, but like the size of a large family pizza, okay? And so they'd be on these big servers, and the data would be recorded on those. We would take those data dumps, and we would go back to PwC, and then they would install all of that data onto a special computer. And I started out in IT specialization for audit, where we would download all of that data and attempt to recreate the financial statements using all the debits and credits. And then we would have to write computer program code to do things like calculate inventory turnover by product line. So computers have come a long way. There's lots of great audit software now that we can use to interrogate data. In the old days, we used to sample, select 10 items that are going to be depreciated and recalculate it. Now with Excel, I'd probably recalculate all of them, because as long as you got the formula right and then you go copy-paste, you've collected a lot more data. So there's certainly lots of great things about computer-assisted audit techniques. It can check that samples are representative. It can do lots of large tests. If you have a whole lot of invoices and shipping information downloaded, you can get it to highlight which goods were shipped on which date if you're doing cut-off testing. There's also a lot of software to plan, perform, and evaluate audit procedures. In the old days, we relied on the manager on the audit to determine whether we tested all of the assertions for an account. Now, audit software is set up to make sure that based on the accounts that you enter, it knows what assertions you need to test. It can check which audit work papers made by juniors have and have not been reviewed. It can tell you how much of the audit has been completed. So this sort of planning and evaluation stuff has revolutionized audit. And we use a lot more computer stuff when controls are stronger. That's most publicly listed companies. It's very rare. You might come across small private companies where all the paperwork is still actually paperwork, but not all that often. In terms of evidence, persuasive evidence is what we want the most of. All right, so that just sort of, those are the ones that we want the most of. It's reliable, it comes from well-controlled information, and it allows me to estimate the balance of an account. All right. It could be vouching, we could get it from tracing. Here's some analytical procedures that could be persuasive. So this is the persuasive ones. Oh, I can't spell persuasive ones there. There's corroborative evidence. Now, this is also pretty powerful, because what we're doing a lot of the times is we're taking journal entries, which is the direct evidence, and then we're trying to check that against other pieces of paper from different parts of the organization. So corroborative evidence is good. Here's some analytical stuff that is corroborative. And then there's minimal. All right. Now, this is the stuff you don't really want. Right? You don't want evidence that is not persuasive, is not corroborative. But But sometimes this might be all you get. All right? But the more of the persuasive and the corroborative stuff you can have, the better. So here are my 4 rules, and I'm going to put lots of these on here because this is how important this is. All right? This comes down to last week when I talked about how at the top of the education pyramid, and I'll add this, where is it? In my photos. All right. So when it comes to this pyramid here, first year subjects really are about testing these sorts of things. All right. Theoretically, according to education design, second year subjects should be about these analysing and applying things. And then third year subjects should be about creating and evaluating. All right. The creating stuff is the key stuff for you guys. Right, designing and creating from scratch. Now, certainly we've got lots of examples to use as basis points or as reference points, but this is the key thing you need to be able to demonstrate in an exam to pass this subject, because this is what real life is about in this particular industry. So, I'm going to go through my 4-step process to designing great audit procedures. So this doesn't come from the textbook, so you'll notice it's not in your textbook, but this is something that we've worked on over time. And if you can follow these steps and these rules, you'll be sweet. All right? Even though I say that, lots of students still don't follow these rules and end up in a lot of trouble. So, to design an audit program, there are some simple rules for auditing. Number 1, use the right technical name for a procedure. We've got 9 procedures: vouching, tracing, inspecting documents, inspecting physical assets, recalculation, confirmations, inquiries, observation, analytical procedures. All right? Use the correct terminology. That's not because I don't know what you're talking about when you explain what you're doing, but it's about being part of the profession. All right? You don't hear doctors talking about shin bones and elbow bones. They use the correct terminology. They say, okay, we're going to remove the blah, 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 or we're going to put a pin in the blah, 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 because the technical knowledge is consistent across the discipline. That means everybody's on the same page. Second thing to be worried about, use client-specific terms for documents, policies, procedures, roles, and jobs. The warehouse manager at one place might be called the warehouse manager. Somewhere else could be called the inventory specialist. At somewhere else could be called a warehouse supervisor. All right? If you use client-specific terms for documents, people, departments, etc., when you go to ask them for something, they know exactly what you're talking about. All right? Cloud9 uses dispatch notes as their proof of shipping. Peters of Kensington uses, I think, shipping manifests. So if you go to Peters of Kensington and you say, I'd like to see your dispatch notes, they go, we don't have any. What are you talking about? And you go, oh, they're missing the dispatch note, no control, let's go to substantive testing. So you could make a wrong decision or come up with some wrong information. So you need that to be specific. The next thing, be as detailed as possible. Someone should be able to follow your exact instructions. All right. Number 1, you could, win lotto and you go off and leave the audit team hanging. I'm sure nobody would do that. Everyone would finish out their audits and then escape to a, nice Brazilian island. Something bad could happen, hit by a bus, something else. You're in a coma, everyone's going, what are these audit tests? I don't understand these audit tests. So if you've written them down, then that's good. Most likely scenario, because our chances of winning lotto or being in a serious accident and losing all memory of our audit processes, is you get busy. All right. End of the financial year and the audit season is extremely busy. They're working 16-hour days at some points. I see them on Facebook, and there are students, former students, still auditing, and they're taking photos and posting them on Facebook of themselves at 11 o'clock at night, high on Red Bull, pizza, and sugary snacks. So when it gets busy, you might have to leave half of a job undone and go to another client and handle an emergency. If you haven't specified exactly what you're doing, whoever takes over from you could be really confused or do the wrong test, or you've tested one way and they've tested another. It's sort of like when I give my husband instructions. Right? He works from home, so often I will say, I'll put some laundry on in the morning and I'll say, look, at some point can you handle the rest of the laundry? Which means put the laundry up on the washing line and then take it in before it gets dark. All right? Especially in winter, because if you don't get your laundry in before it gets dark in winter, it gets all cold and then the dew sets on it and then it's all wet. Right? But if I say to him, can you please put up laundry? That is all he will do. He'll put it up and then he won't take it down. Because he'll say, and he's very literal, he's extremely, extremely smart, but he's a bit like Sheldon Cooper in that he takes instructions very literally. So I have to say, can you wash the clothes on this cycle? And then put them up, and then before it gets dark, bring them in. Otherwise, it won't happen. Right? Sort of same with, I've just realized that giving instructions to my husband about these sorts of things is also about giving instructions to my toddler. I can't just say clean up. I have to say, put the train sets away, put the puzzles away, put the octonauts away, put the books away. I can't just say clean up because it's just not specific enough. So you need to be specific to follow your exact instructions. And then the last one, make sure our procedure is testing either the correct control if your control's testing or the correct assertion. Right? There's no point in vouching if you're testing completeness. It's completely the wrong sort of test. So you need to do the right thing. Now, if you can get these 4 points under control, and you can design procedures and create procedures using those 4 points, you are going to be absolutely fine in this subject. All right? It's part of the reason why I'm getting you guys to do the field studies, because the field studies is about getting out there and seeing real processes, so that then we can design based on those business processes as well. All right? Now, if you really want to take the immersive 100% audit experience, do this at work, or when you're on the train, or when you're in the supermarket line. Look around and say, oh, how could I substantively test sales at Woolies? Specifically the accuracy assertion. Or how might I test the existence assertion of inventory at a sporting goods store? All right? If you are in the line at a nightclub and you're sitting there thinking, okay, well, I'm waiting in the queue because there's lots of people and, they only let a certain number of people in at the time. You have to pay cash. What controls are there over the handling of cash? How can I be certain that the amount of revenue or cash that's received is the amount of revenue that's recorded and employees aren't pocketing cash? Right? Immerse yourself in the audit experience is what I recommend. Nerdy but useful. Okay, evaluating results. Evaluation is really important because we need to know what to do next. All right? So I have to do, the first thing is, what's an error or a number that's clearly wrong, and then what's a judgmental misstatement where I have a disagreement with management about how something is done. Now, the disagreements with management, the judgmental misstatements, are more likely to be around estimates. All right, so we have accounting estimates, intangible assets, depreciation, goodwill, all right, are all things built off estimates. And management have to make judgments, right? That is the dilemma of management. Their job is to make accounting policy choice because we know that from ASR that there is accounting policy choice on revenue recognition, on inventory valuation, and accounting, weighted average, or FIFO. We know that we've got different methods of valuing executive stock options. How do I know that my impairment of intangibles is exactly correct? So for those estimates, we're more likely to have these judgmental misstatements, all right? Where we get an expert and the client has an expert and then the experts battle it out to decide which number is correct. This one here, errors and fraud, is where there's clearly a mistake. All right? They've had duplicate sales. Their system went all haywire and it recorded double sales for a particular period in time. Those are errors that clearly need to be removed. And so there's a lot of discussion between the auditor and the client. There is a lot of negotiation. All right? And up until maybe 10 years ago, or a bit longer than that, maybe 15 years ago, even now in textbooks sort of make this assumption that you as the auditor come up with your list of 50 misstatements that you found, and you give them to management, and they either change them or they don't. If they don't change them, then we give them a modified opinion of some sort. But what happens in reality is there's lots of negotiation. I think KPMG might have been the first audit firm that had experts in negotiation come in and train their audit partners in negotiation tactics. Right? Win-win negotiation styles, trying to read the person on the other side of the table from you that you're negotiating with, how you approach the negotiation. Professor Ken Trotman, who's a professor in auditing, behavioural auditing at the University of New South Wales, pioneered a lot of the research on investigating and uncovering these negotiation processes. So it's sort of like buying a house, right? Haggling for a car. Management want to make as few adjustments as possible. The auditor wants, hopefully, all of their adjustments to be put through. So then we have to strike a fine balance. I also have to decide, as the auditor, whether I'm looking at something that's a one-off event. Oh, look, fat finger, I injured my finger during the week doing some yard work. So then I have this big bandage on my finger, so when I was typing in the numbers, I accidentally typed in one number too many. All right? Or is it a systematic error? Is it a problem with my internal control system, which means that for every single transaction we've executed over the entire year, I've got a $1 misstatement over 1 million transactions or 1 billion transactions, which could roll into something really big. So I need to evaluate and document my results for each program step. So usually an audit program step is related to, each step is usually related to one assertion. All right. And an entire audit of a company will have lots of different audit programs and steps. So I need to look at each account and each assertion. Right? I can't just test sales for occurrence and not also test it for accuracy. All right. Now, what I also need to do is understand the client's business. Can anyone tell me what ASA says we need to really understand the client? Anyone remember? 315. All right. So ASA 315 says understanding the client is key, because what we're doing is we're doing a risk-based audit. All right. We are auditing and spending more effort where there's more risk. So if I don't understand the client, I can't understand where that risk might be. I can't understand what fluctuations I might expect to see. So if I'm auditing a mandarin company and suddenly they have lots of sales in December, I'd go, that is definitely not right. If I am auditing an import firm, all right, and profit, that's the pie symbol, is down, but nothing else has changed. The volume of sales has not changed. The prices that we charge our customers has not changed. If I was an importer, what has been happening recently that might see my profit drop?
Aussie dollar decreases.
Yes, so the value in the Australian dollar against the US dollar has decreased down to 69 cents today. But, with Malcolm in power, we saw the dollar bump 0.5%. So if I'm an importer and I saw profit go down, then if I didn't understand the business, I wouldn't be able to say, oh, look, that is probably mostly driven by a change in the foreign currency. The same if I was an exporter. All right, what would I expect to see for exporters, assuming everything else is equal, but with the dollar falling? Profits going up. Profits going up. All right, so that makes it really important to understand our business. And then if we understand that, that helps us to interpret the results. So, and this is a really important one down here, absence of a fluctuation could be just as suspicious as a large fluctuation. All right, because if you know that you are selling running shoes, for example, like Cloud9, you know that there's usually a spike around certain events, City to Surf, running festivals. Just when you get to the end of winter, you tend to get a little bit of a peak because everyone's like, oh, I'm going to get fit for summer. There might be a spike when it's back to school. Right? So in the week before back to school, you probably expect more sales. But if you didn't see any of those fluctuations that you expected, that could also be really sus. All right? So it's about knowing what you're looking at and what also might be missing. All right. So I want somebody to give me a publicly listed a company that makes something. McDonald's. All right. So I'm going to add here. All right, I'm going to do that in that bright red that McDonald's is known for. Okay, so I'm just going to put this up here. Okay, now, let's audit. Okay, I won't do revenue because revenue is going to be a little bit tricky, but let's look at accounts payable. All right, because I know that they've got suppliers. Obviously, they have to buy all the different bits and pieces. So we're going to look at accounts payable. So we're looking at a balance. All right. So what assertions are going to be important for balances?
Accuracy. Not classification. Valuation.
Yes. Valuation and allocation. All right. So we've got valuation and allocation. What else is there? Existence. We've got completeness. All right, let's make this a bit bigger. What else is there? One more. Rights and obligations. Okay, I might space these out a bit more. All right, so I am going to design some procedures to fit in here, not having thought about the company at all, right? So I definitely didn't ask you to say McDonald's until just then. So let's have a go at doing this. This is the creation part. I really like this part. Okay. Oh no. Stay that colour green. No. That one, that'll do. All right, now let me pick a different colour. Let's go with blue for the first one. How do I check the valuation of accounts payable? I need to do some form of recalculation, maybe?
Inspection of invoices.
Yep, so let's do a few different things. Let's select a sample of accounts payables, and recalculate the amount owed by examining outstanding invoices. All right. Oh, probably let's make that even more clear. Select a sample of accounts payable and recalculate the amount by tracing to outstanding invoices. There we go. All right. So that's one there I could use for valuation and allocation. Would I have any accounts payable that I would need to worry about whether they're current or non-current? Not really. Right. If I was looking at a wine company and maybe inventory, I might have some non-current inventory. But here, we're just going to worry about the valuation of the accounts payable. Now, I'm going to come up with another one, just to show you I can do two. I could do request a written confirmation of amount owed to 5 largest suppliers. All right. So that's just another idea on the sorts of procedures that we could do. Let's shrink that one down, fit that there. Okay. Whoops. All right, next one. I'm going to do existence. How could I prove that accounts payable really exist? Yes, so I could vouch outstanding invoices to physical inventory. All right, so there's one. Let me come up with another one. We could request confirmation of amount owing. So that same confirmation that I used above, even just if the supplier writes back saying, yes, we're owed money, that's proof that they exist. All right. What about completeness? This is probably the big one. If I had to think about issues around accounts receivable and which one, which one is really going to be at risk, then I'd really think that completeness might be one of those things, because management's more likely to understate. Okay, so how would I check to make sure that I've recorded all of my accounts receivable? Accounts payables.
You could trace them all vouching, but make sure you've got all the documents, like the purchase order.
Yes, so we could do a few different things. Trace a sample of purchase orders through to receipt of goods, invoices from suppliers, and accounts payable journal entries. All right, that's a good one. Let me see if I can come up with another one here for that same completeness test. I could, and this is a new test that I'm going to talk about here, conduct a subsequent cash payment test. All right. Now, the subsequent cash payment test is when you look at bank payments after the end of the financial year. All right, so in the 30 to 60 days after the end of the financial year, you look at money flowing out of the company and you try and match it back to an accounts payable. All right, if you can match it back to a listed accounts payable, that's great. But if you've got outflows that do not match to any sort of liability that you can find on your books, then that is potentially an unrecorded accounts payable. Right? Just because you don't put the journal entry in doesn't mean that you can get away with not paying the supplier. Because if you don't pay the supplier, they're going to send you a debt collection letter. They might refuse to supply to you. All right? If you've perhaps bought from the wrong people, they might send someone around with a baseball bat. Or, if you're buying from the mafia, they could send someone around to, leave a dead horse head in your bed or something really serious. I'm sure that's probably never happened to any publicly listed company. But we certainly need to consider the possibility of a subsequent cash payment test. The opposite of that, the subsequent cash receipt test, is the best test ever for existence and valuation of accounts receivable. Because customers never respond to receivables confirmations. So you just look at who was paid in the 6 weeks after to confirm the amounts. All right, and then we've got one more, rights and obligations. So how would I prove that I have a right to recognise, an obligation to recognise that accounts payable? When do I owe the money? When goods are received. All right, so I could do a couple of different things. My first one, trace a sample of purchase orders from I'll choose the last month of the year, and for those where goods are not received by 30 June, ensure no accounts payable exists. Right? So you're tracing, but you're actually tracing hoping that you don't find anything. Oops, I'm missing that last little bit. Does that sort of make sense to everybody? You're tracing, looking to find nothing. You could also, let's come up with a different one. Select a sample of goods received in last 2 weeks of the financial year and check that accounts payable has been recorded. All right, and here is an example of me looking for an actual transaction there. All right, so there, the first one up here, I'm looking for things that might not be there, or shouldn't be there, and here I'm looking for ones that should be recorded. Does that make sense to everybody? Yeah? So I've designed 1, 2, 3, 4, 5, 6, 7, 8 procedures for accounts payable at McDonald's just on the fly. All right. Now, of course, I have 10 years experience of doing this in the classroom environment. You guys have no experience at doing this in the classroom environment. So that's what the next few weeks are going to focus on once we come back from term, is about how do I actually do this? How do I develop this skill to create and to design? Okay, and I know that you guys aren't particularly arty. I've asked that before about who's arty and likes to draw or might be a little bit creative. And I'm going to use an example from one of my former students, Jamie Fleming, who was a MasterChef contestant, right? He came, I think, the final four on MasterChef. And he said, well, one of the keys to being great at the mystery box. Do you know what the mystery box is? You get, there's a fish head and a block of chocolate and a pineapple, and they say, go make something, all right? The key to doing that and to doing that well is practice. Van Gogh and Picasso and Monet didn't just pick up the paintbrush one day and just paint masterpieces. They started out sketching, right? I've seen lots of documentaries about how great artworks have appeared, and often there are, previous attempts that are not so good as the final result. There are sketches. Often when they've looked at old paintings, when they've done some analysis, they found, one fantastic painting on top. And in the old days, they used to reuse canvases. So they found like another painting underneath, which was like an early version of something else that turned out to be really fabulous. So for you guys, the key is practice, all right? Now, certainly you can watch all the videos where I give lots and lots of examples, and there's, I think, 4 or 3 videos this week where you watch me design tests. But just like watching people run marathons doesn't help me get any better at running a marathon, watching me design procedures doesn't help you get any better at it. So the more that you can practice, just in your own head, you don't even have to write it down, the better that you're going to be prepared for the final exam and for the video interview assessment, which starts not the first week back, but the second week back. All right? So for video interview assessments, please, hang on, I'll stop the recording so that people don't have to listen to this bit. Hang on slide. So these are all the things that you should do, and I'll pause the recording here now.